Let's take a deep dive into annuities today. So, first of all, what is an annuity? An annuity is a contract that's created by an insurance company. Could be a security, could just be an insurance product, or could be both. And it's guarantees you a payment for the rest of your life. Guarantees you a payment for the rest of your life. It essentially is the opposite of life insurance, because life insurance pays you while you die, annuities pay you while you live. Life insurance pays you while you die, annuities pay you while you live. And it actually kind of makes sense for a risk profile for an insurance company to offer both products on their platform, because it kind of diversifies the risk, right? With a annuity, you have the risk of someone living until they're like 150 years old. And then with the life insurance, your risk is that, let's say you have a term policy and a young man dies and gets like $5 million when he barely paid any premium. So that's kind of they're essentially the opposite. So let's talk about the different kinds. I personally divide annuities in 3 buckets, and you can mix and match the different buckets. So you have immediate annuities versus deferred annuities. You have non-qualified versus qualified, and then you have fixed versus variable. And in the fixed bucket, there's also the equity indexed annuities and the fixed indexed annuities. So let's talk about immediate versus deferred. With an immediate annuity, it's an annuity that starts paying you out within 60 days for life, right? So essentially that happens a lot when someone wins a massive court case or something like that, or they get a big inheritance. They just want to get paid a ton of money and it be guaranteed until they die. So they'll dump it in immediate annuity, right? So annuities, the way they're structured is the flow of funds only goes in a single direction. So either I'm paying the company or the company's paying me. There's no way that we can be both paying each other at the same time. That's just how they're structured, right? So it has to be by default a single premium. If it's an immediate annuity, it has to be a single premium because, otherwise, how are you going to have a periodic payment when you're going to get paid in 60 days? I mean, I guess theoretically you could maybe put in like half like this week and half next week or something like that. But essentially, for the purposes of exams, it's considered to be a single premium. Another important thing to note is a lot of people remember the rules, like for most retirement plans, the 5 years and 59 and a half. Now, you would think that kind of falls flat on its face when it comes to immediate annuity, so you would get hit with a 10% penalty, but it does not. So there's like a carve-out, which is called substantially equal periodic payments, which does apply to annuities and does apply to 401k plans as well. A lot of people don't realize that, but you can take out money in substantially equal periodic payments before the age of 59 and a half. But with annuities, that's how they're able to do that. And even with variable annuities, the payment fluctuates, but it's still substantially equal. Still very, very similar, the payments. So that's an immediate annuity. A deferred annuity is going to basically mean that you're going to hold it for X amount of time, however long you want, and eventually you're going to annuitize, right? Eventually you're going to annuitize. So those you can have as a single premium, which is like a single payment. You dump $100,000, which is probably going to be a non-qualified annuity, right? We're going to talk about that next, because how are you going to do that? I mean, theoretically, you could have a single premium, a single premium immediate qualified annuity if you just had let's say a 401k and you just put the 23,500, 24,500, never put anything in again. That kind of be a weird way of doing it, but theoretically it's possible. But most of the time it's going to be a non-qualified if you're going to dump a bunch of money in a single premium, deferred annuity. So the other way is you could have like a periodic payment, or you can even have a hybrid where you dump money in one shot and then you also keep contributing money periodically. So with a periodic payment, with a periodic payment annuity, essentially you're just putting in payments periodically, right? You put in payments periodically. And if it's going to be a variable annuity, you're going to have what are called accumulation units that accumulate. There's going to be a variable number of them. And then eventually when you annuitize, you get a fixed number of annuity units. I use this analogy with water balloons, where you're buying all these little water balloons. And eventually when you annuitize, you have a set number of water balloons. Just the amount of water per balloon is going to change, right? So we talked about the deferred. We talked about the single premium deferred, and then the periodic payment deferred annuity. So now let's move on to the next bucket: qualified versus non-qualified. Qualified in the context of annuities just means pre-tax money versus non-qualified is going to be an annuity on its own. So it's going to be after-tax money. Not like a Roth, though. Not like a Roth. You could theoretically have an annuity inside a Roth account, but I don't see that asked a lot. So, if you take an annuity and you put it inside a qualified plan, like a traditional IRA or a 403b or a 401k, it's basically like a chameleon, and it takes on the properties of that retirement account itself. So let's say you dump it into an IRA. So then you have the 7,000 contribution limit with the 1,050 plus catch up. You're going to have, obviously the contribution limits, and it's going to have the same treatment where all the money is going to come in pre-tax, come off from your pre-tax income, and then later on you're going to have to pay full ordinary income on the way out. So just one important thing to mention, no capital gains with annuities. Capital gains never comes into play with annuities. So don't get tripped up with capital gains and annuities. They're like magnets where, they push away from each other. No, unless the question's like, what does not have to do with annuity, then it's capital gains, right? Non-qualified annuities, the money would come in after taxes, and then it would grow tax deferred, and then it would come out ordinary income on the way out. LIFO on the growth. So sort of like a hybrid between traditional and Roth, where the money would come in post. Well, both of them, whether it's qualified or non-qualified, they both be tax deferred, right? So whether it's pre-tax or post-tax, it's still going to grow tax deferred, right? So post-tax, then tax deferred, then LIFO. So what does that mean? If you ever do decide to annuitize, right? It would actually all be taxed according to the exclusion ratio, which is just a set ratio that the company would set. So let's say you have 10% is your how much you put in, 90% is growth. So they probably hit you with like 9-to-1. Obviously you don't have to know how the formula is calculated. It's done by actuaries, but essentially that's how it would be. Versus if you were to take out the money during the accumulation phase, that's where the 59.5 in 5 years would come in, and then it would come in last in, first out. So if you put in 100 and now you have $1 million, the first 900,000 would be taxed, the last 100,000 would be basis. Versus life insurance is actually first in, first out, so it has the more beneficial taxation, right? Last bucket. Variable versus fixed annuities. Fixed annuities, you have a guaranteed rate. It's almost like a pension plan compared to like a 401k. So defined benefit versus defined contribution. You know exactly what you're getting. Inside the fixed annuity bucket are called equity indexed or fixed index annuities, which essentially for now they're considered fixed. So because of the fact that they have like a floor of 0, or they could have a higher floor, so you can't lose money. So that's why they're able to be called fixed annuities. They're usually pegged to the S&P, and essentially how they work is you have a set floor, and then you have a set ceiling, and basically, or cap. And then you get a participation rate, which is a percentage of the gain, or a spread fee, which gets subtracted off the gain. The key is it cannot exceed the floor, and it cannot exceed the ceiling, and it cannot go below the floor, right? And then with a fixed annuity, you don't need your series, with a variable annuity, you would need your Series 6, 63, SIE, and life and health at a minimum, right? You could also have your 7, 66, and SIE. But with EIA or FIA, you just need your life and health. So it just pegs to the S&P, and you can't lose money. Now we talk about variable annuities. Variable annuities are the ones with the accumulation and the annuitization phase. You're picking these various sub-accounts that are registered as mutual funds, and they're part of the separate account, and basically the ball's in your court, right? The ball's in your court. And one important thing that I did want to mention when it comes to the accumulation phase, it's only then when you have a death benefit where if you die during accumulation, you could pay for an enhanced death benefit, but the regular death benefit would be the greater of your account value or your sum of contributions in case the account goes down, right? So you have your accumulation phase, then you have your annuitization phase. You pick the various sub accounts in the separate account, and your accumulation units would grow, and then when you annuitize, you have a fixed number of annuitization units. Now, when you decide to annuitize, what you're essentially doing is you're giving up your separate account to the insurance company in exchange for payments for life, and they're going to be based on which settlement option you pick. You can pick Straight life, which would just say, hey, I'm just going to get payments for the rest of my life, but God forbid if I die very soon, my beneficiary gets nothing, right? But I would get the highest payout, right? So let's say if it was like a 10 million account, I'm just estimating here, let's say it was 10,000 a month or something like that, right? So that would be like the straight life option. Then if it was, there's life with period certain. So for example, if you had a young child, maybe you'd get like a 5 or 10 year period certain to make sure if you die, your young child would still keep getting paid out for that period of time. Now, it's not an extra 5 or 10 years add-on. It's just within that period of time. So meaning if you were to die past the period certain, your beneficiary still gets nothing, right? Then we have joint and last survivor. That's just multiple people. That's like, 2 or more people. And, usually it's husband and wife. Husband dies, wife keeps getting paid. Last one is going to be unit refund, which is the most beneficial to you, least beneficial to the company. So it's going to give you the lowest payout, right? Since it gives you, but basically, essentially, if you were to die early and there's money left in the account, your beneficiary would get that as a lump sum or in periodic payments. So that's the most beneficial to you, least beneficial to the company. Last thing on that with variable annuities, your payments are based on what's called the assumed interest rate, which is basically like a hurdle or a benchmark rate that the company sets. Essentially, if you have an AIR of 4% and your separate account, which is the sum of the sub accounts, right? You have these various sub accounts that you pick that are mutual funds, usually open-end funds, and you pick the various sub accounts, and let's say the AIR is 4% and your account is 8, that means the following month your payment's going to go up. If it goes below 4, your payment's going to go down. And then if it stays at 4, you just keep getting paid the same payment. And, there is something called a GMIB, a guaranteed minimum income benefit, where let's say if someone needs, whatever, X amount per month to make sure that they're, they could pay their bills, they can lock in a GMIB, but that's going to cause them more fees. Same thing with like a bonus annuity, right? A bonus annuity is where they'll give you basically kind of like free money, essentially, wouldn't be taxed until later. But in exchange for that, they're going to lock up your money for a longer period of time. So, for example, you can have like a 10-year contingent deferred withdrawal charge. And if you take out the money, you would just get taxed at whatever, or no, you would hit with a penalty and potentially, taxes either way, and even a tax penalty. So you could get, the fees can add up quite a bit. There's also a concept called a 1035 exchange, where you can exchange the annuity for another annuity, or the annuity for, you can go annuity to annuity, you can go life to life, you can go life to annuity, but not annuity to life. The reason being is because with annuities, you pay taxes on the way out. With life, you don't. So it's like, and it's more beneficial taxation, so they don't want people to game the system, right? Also with 1035 exchanges, you got to be mindful that people shouldn't be 1035 exchanging generally if it's more recent than 3 years. If it's under 3 years, you shouldn't be 1035 exchanging because of the fact that there are some folks that were kind of abusing it, and also you gotta think about the customer as a priority, and it has to really make sense, because they're going to get hit with a contingent deferred withdrawal charge, right? Because it's almost like a 1035 exchange is the opposite of a mutual fund exchange. So the mutual fund, if you go from a large cap to a small cap with the same family, you pay taxes, it's a taxable hit, but there's no like sales charge. With a 1035 exchange, the opposite. So there is no taxable hit, but you will pay a sales charge or a contingent deferred withdrawal charge, which can be quite substantial. That's kind of annuities in a nutshell. So please like and subscribe, and hope you have a great night. Thanks.